Right, it's 12:30. We're going to start the webinar now. Danny Andropoulos and I will be dealing with the webinar this afternoon, and we'll be introducing our panelists shortly. If everyone could just remain on mute while we introduce the session. So welcome to clients and to Worksman's members of the firm that have joined us today. The Worksman's webinar today is about constraints, challenges, and opportunities in the leisure industry. And Danny and I have been speaking about this for some time. We think it's opportune. It's the end of the year. People are kind of got one eye on the beach, one eye still on some remnants of work. And I do think that the timing is right for us to have this conversation this afternoon. So my name is Eric Levenstein. I'm a director at Worksman's and I'm head of the Worksman's Insolvency, Business Rescue and Restructuring Department. I, together with my director, Danny, will be joined by leading industry leaders to discuss the issues of the pandemic, the effect on the leisure industry, and where we're looking forward to towards the end of the year and into 2022. There's no doubt that the leisure industry continues to take a pounding, both in the South African market and in international markets. And we've seen many businesses, whether it's restaurants, hotels, and the like in the hospitality industry, have had no option but to close down, some of them filing for liquidation and some filing for business rescue. And I think one of the takeouts and why we thought it would be important to discuss this aspect this afternoon is that a lot of organizations are not fully up to speed, or let's say aware of the options, how to deal with financial distress, whether you're a director or manager of a company that is in trouble. And I think many of our clients potentially will be trading with parties or with companies that might be facing these constraints. So I think the need to right-size staff components, reorganize bank debt, look at reorganizing potentially management, retrenchments, maybe downsizing staff, all part and parcel of a restructuring. And Danny and I have seen this over a period now in the last, let's say, 18 months, almost 2 years now. And I think today's webinar is really about exploring restructuring strategies, business rescue, liquidation, and looking at business rescue potentially as a tool to unlock real value and look at what the lessons that have been learned over the last period and to see where this sector, the leisure sector in particular, is going into 2022. So Danny, if you want to maybe just add a few words as an introduction.
Yeah, Eric, I think you've said the bulk of what has got to be said. I mean, there's two ways to look at this webinar, and we are taking two approaches in presenting it. The one is to tell people out there you're not alone in the leisure industry when you're feeling pain. And you'll hear from our panelists, and you'll see the way they've elected to deal with the challenges that COVID has introduced into the system. The other is to look at the potential opportunities that arise out of a COVID environment. You know, it is ultimately survival of the fittest. There are opportunities out there, and certain of the panelists will tell you the steps that they've taken. Number one, to protect themselves against the fallout of COVID, and number two, to take advantage of the opportunities that present themselves.
Great, so let's kick off then, Danny. I'm going to introduce the panel and they can come on screen as I go through the list. We have really got a great panel for everybody to share with this afternoon, to listen to and to explore the ideas we've been talking about. Firstly, Andrew Johnston is the General Counsel at Sun International. His official title is Corporate Services and Group Company Secretary. Andrew's been responsible for all corporate administration at Sun International now for a number of years, in fact, since November 2016, dealing with governance, investor relations, and generally with activities throughout the Sun International Group. I've known Andrew for a long time. Believe it or not, we played rugby at some point and we're at university together. So Andrew, welcome. Then moving on to Bernard Monteverdi. Bernard is the executive advisor to the business rescue practitioners of COME. I've got to know Bernard very well in that particular restructuring. He's been involved in the COME business rescue process since 2020 and has been intimately involved in the turnaround and restructuring of Comair, which flies Kulula and British Airways in South Africa. So welcome to Bernard. We look forward to his thoughts a bit later on. And then we have Mark Laxberger. Mark is the CEO of the Capital Hotel Group, consisting of over 1,600 rooms under lease, ownership and construction in Sandton, Rosebank, Pretoria, Shanga and Cape Town. Very involved in the hospitality industry, and in preparing for today, Mark's certainly going to share some very interesting thoughts and ideas on where we're going in South Africa. So welcome to Mark. We then have Andrew Stark. Andrew is currently the Managing Director for Flight Centre Travel Group, Middle East and Africa, and has been for the past 7 years. In preparing for today, Andrew's got some really interesting ideas, concepts, and where we're going to with leisure and travel over the next few months and into next year. So welcome to Andrew. Andrew has a Senior Executive General Manager role across the world in various divisions and very involved in flight centre travel in the group itself and in the leisure market. So welcome to Andrew. And then we have our representatives of EY, Stephen Smith and Alison Tim. Stephen is the EY Africa Turnaround and Restructuring Strategy Leader. His role as a financial and business restructuring professional is well known throughout South Africa. I think Stephen's been here from the very beginning when we got Business Rescue in 2011, and very highly specialized in turnarounds and restructuring. So welcome to Stephen. And then Alison, also at EY, as an associate director, has very extensive and practical experience in advising stressed and distressed businesses. And both of them have some very interesting views, firstly on an appointment that they've taken in Ster-Kinekor, and also sharing with us their overall view as business rescue practitioners and turnaround experts in South Africa. So that's the array of people we've got for you this afternoon. Before I hand over to Danny to have a chat to Andrew, I just want to say, please post any questions in the Q&A chat. I will monitor those, as will Danny, and we will certainly try and answer those questions as we go along. We hope to finish at about 1:30 or just after. So Danny, over to you.
Thank you. Andrew, I'm going to address my comments initially to you, but you do, and both you and Mark need to know, I'm a hotel brat. My dad was in the industry all his life, and I lived in hotels extensively. So when I see pain in the hospitality industry, my heart goes out to you. Andrew, if I can commence proceedings with you, looking at Sun International, which has got a massive footprint, is a household name. How has Sun International dealt with the impact of COVID and the fallout in its business? In particular, how has Sun International managed and pivoted around lockdowns in your hotels and casinos around the country, and then still kept going despite the pressures of the pandemic? Let's look at Sun City, for example, which is a combination of gambling and hotel offering. Pressures must have been extreme. So how did you cope with it?
Thanks, Danny, and good afternoon, everyone. It's great to be on this webinar with all of you. Yeah, I think the last 18 months, probably the best way to describe it, it's been the perfect storm. I think everyone in this industry will appreciate and recognize that we went from a business as usual to very much a business unusual environment. And there were definitely certain strategies and learnings that I think have come out of this. I think as an industry, you know, everything that happened couldn't have come at a worse time. And I think what did come was really almost directly adversely pointed at our industry, you know, whether it was alcohol bans, whether it was curfews in the gaming or the casinos, social distancing in restaurants, hotels, casinos, travel bans, particularly inward domestic and or inward international leisure and domestic leisure. And then obviously the capacity restrictions that we had in restaurants and casinos. I mean, it was catastrophic in many respects, and it really required for some harsh decisions, but some very agile decisions. Yeah, I think on the positive side to all of this, and one always tries to look at the positive, particularly in our industry. I use the analogy, you know, the leisure industry is tuned on 24/7, 365. And one of the positives, I think, that came out of this, you know, we could take this Boeing 747 and for the first time in probably 50 years ground it and actually do some maintenance on it, which previously was very difficult. You know, it was like trying to maintain a Boeing in full flight across the Atlantic Ocean. And it was obviously more sort of tinkering and dealing with where there were problematic areas as opposed to looking at the business holistically. But I think, you know, some of the impacts, I mean, we saw, and I'm sure everyone else in this industry, I mean, we had to react really quickly. We had to protect our balance sheet. We had to obviously look at where future revenue and inflows were going to come. We had to make sure we continue to trade as a going concern. And at the same time, obviously keep, you know, stakeholders and whatever happy. So if I just look at some of the kind of things we did, I mean, obviously efficiencies was top of mind. The regulations required us to literally shut down South America, where we had a lot of ops, closed down actually a month before we went into a hard lockdown in South Africa. So we were already putting out SENS announcements in the middle of February last year saying, early March last year saying, you know, we were going to be closing those down. And then obviously we went into the hard lockdown here in South Africa. But you know, there was mothballing of operations. We had to do a deep dive in terms of what was still profitable, what we were going to keep, what we were going to close. Most of the staff went on to a form of temporary layoff, massive retrenchments, about 3,000 people in our organization. All of us went down to 40% of our annual TCOE, so we lost 60% of our income each month. There was a freeze on employment. 0 increases for FY 2021, no short-term bonuses. Yeah, it was hard. It really was hard. But you know, in addition to that, obviously you had to look at all of our contracts. We went to market, did a rights offer, raised 1.2 billion to prop up the balance sheet last year. Had to obviously look at contracts from, you know, force majeure, supervening, really engage with all of our stakeholders. Engage with our lenders around obviously refinancing of debt, getting relaxation of covenants. Obviously, the trade unions were quite difficult in all of this with the large-scale retrenchments. And shareholders were concerned. I think, you know, in this whole industry, there was no doubt it was under a lot of pressure and a lot of stress. We had a purported hostile takeover just to add a little bit of additional fun in the year, which we had to court. And yeah, it was an interesting year. But I think, you know, if I had to look at the 3 things that probably came out, disclosure became absolutely paramount. Disclosure with staff, disclosure with stakeholders, shareholders, engaging with all of our stakeholders for various and different reasons. And then really that ability to be agile and to respond quickly and effectively to what we understood was going to be not a 3-week crisis that we all thought, but possibly something a lot more prolonged and protracted.
Tell me, we've now had 18 months to live through this, and with the benefit of hindsight, and hindsight is always 20/20 vision, would you, and with the prospect of better times ahead, given that the COVID numbers are dropping, that your, I think Andrew Lemming recently stated that he believes the worst is over in the travel and hotel sector and the tourism and travel will rebound in 2022, and from his mouth into God's ear. Would you have done anything differently now that you have the benefit of hindsight? Were there lessons learned?
Yeah, I think so. I mean, you know, I've sort of jotted down a couple of them and maybe just, you know, if I can read them. I think investing in preparedness is an absolute imperative. It's no longer a luxury. You know, we live in uncertain times, and I think, you know, this really forced all companies, listed or private, to really invest in being prepared for these kind of crises. I think, you know, communication, as I said, was absolutely key. You know, King 4 always spoke about the stakeholder inclusive rather than the shareholder exclusive approach, and I think that these events of the last 18 months have really fast-tracked that. I think, you know, more so than ever, companies have had to understand, respect and collaborate with your stakeholder groupings. I mean, obviously, we all know virtual meetings has now become part of the corporate landscape, good and bad to that. I don't know. You be the judge. Yeah, I think crises require agility and innovative decision making. And I think if I look at the structures we had to put in place during this period, you know, from creating COVID crisis committees to, you know, making sure that the board took a more active role in the business given where it was, but at the same time maintaining those boundaries and you know, between directors and non-executive directors and management obviously was really critical. I think technology has become a huge enabler rather than an end in itself. I think a lot of companies have moved to electronic board packs. I mean, we've seen Zoom and team meetings, proxy voting, e-resolutions. You know, I think the digital age and era has also been probably fast-tracked out of these events. I think relationships, both intra and extra the company, have changed forever. I think everyone in this industry will realize that the, you know, collaboration, banding together, lobbying with regulators, industry sectors, and that have become really, really critical. And I think last and probably not least is the need to really seek full alignment on strategy, value, culture, and making sure, you know, that the top management, the executives lead from the top and walk the talk and not just talk the talk. But I think those are really, really valuable lessons.
Yeah, all makes sense. Finally, what, if you were to prognosticate, what is your view of December, January for the hospitality industry? Do you think we're in for happier times?
Yeah, look, I mean, one wants to always look at the half full rather than the half empty. You know, I
agree.
I would probably be saying the wrong thing if I said I think the worst is over. You know, I think the green shoots are definitely there. You know, we definitely, having come off the UK red list and obviously having gone back down to an alert level 1. Plus, I think the vaccination rate in the country, we're definitely seeing a lot more optimism. We're starting to see bookings, especially from our offshore customers, starting to pick up. You know, I think the elephant in the room and the million-dollar question is what's going to happen in December if we have the so-called wave 4. You know, I would like to hope and think that, you know, everyone's learned their lessons. I think, you know, the economy probably is a little different to the UK and other global economies, although we have seen they've gone back into very hard lockdowns. Whether this country will go back into another hard lockdown if they can afford to, I'm not sure. But I think, you know, there's definitely a lot more awareness around, you know, social distancing, people wearing masks, you know, wherever you go, there's, you know, people just seem to be a lot more aware of it. I'm hoping that the vaccination rates will get us to something close to a herd immunity, and we can start to, you know, build this industry again. You know, we never lose sight. It's a major contributor to, you know, national GDP. And I think, yeah, you know, I'm hoping and praying that, you know, these green shoots that we're seeing at the moment are going to be sustainable green shoots. And I think the industry will come out of this stronger. I think, as I said, you know, a lot of us had to really do some deep dives and introspection. And I think there's a lot of efficiencies that have been created out of this. And yeah, we'll have to see where it goes. But I'm generally, hopefully, optimistically positive that we will see some kind of return from 2022.
Thank you, Andrew. That's most interesting. Eric, over to you.
Great, thanks for that, Andrew. Bernard, are you there? Yes, there he is.
Yeah, I'm here.
Bernard, so let's just turn to the airline industry and particularly obviously to Comair, which you've been involved in, as I said, since last year when it went into rescue, believe it or not, in May 2020. And Bernard, just your thoughts on where the airline has come from. Let's go right back to the very beginning. You know, what was the actual causes for Comair's filing for rescue? And obviously you've lived with having to deal with, you know, the fallout from the pandemic, trying to run an airline in rescue, trying to keep, you know, mothballing of fleets was a big issue, trying to keep interest from the passengers that were going to fly towards the end of last year. I think you locked down for about 8 months and started flying in December 2020. Challenging times and not the easiest restructuring to have gone through, and obviously a unique set of facts and circumstances.
Yeah, Eric, I think as with so many of these businesses that were affected by the lockdown, the level 5 first lockdown was the final straw for many companies. And much like Comair, I guess it's subjective, but not really. It's a sort of a fairly black and white to me anyway, that the company was ailing for some time, maybe 2-3 years. Remember, it's a company with literally a 60-year track record of profitability. 2019 was a record year for most airlines around the world, high yield rates, high passenger carry, high volumes. But for nearly 2 years, they'd been struggling with quite a heavy fixed overhead and financing costs. In fairness, the board had recognized this. But didn't come like a sledgehammer. And there were a lot of board changes in 2019, which led to some action. And in fact, we were called in probably in mid to late March to produce a turnaround and restructure plan for them, fairly simplistically, fairly high level. And I believe we'd signed the engagement letter on the same night that the president announced the lockdown. So there was a plan, but with nowhere to go. And so the aircraft or the airline was literally stopped in its chocks. You can imagine no revenue because that's what an airline does. It flies and it generates revenue, but lots of costs. Maintenance has to continue, financing costs continue, fixed overheads continue. And on top of that, the fleet, Comair was a fairly modern thinking airline. They had procured 8 Boeing 737 MAX 8s. We know what happened to them in 2019. They were grounded, I think, by the FAA on the 19th of March. Comair had just taken delivery of its first one, and its second one was due for delivery 2 days after the FAA grounded the fleet. So what that means is for, call it 15 months, they were operating wet leases to make up for the aircraft that they should have had in the fleet rather than wet leasing, which is quite expensive. And then, the SAA award to Comair by the Supreme Court of Appeal in March 2019 had awarded them 1.2 billion rands worth of damages. They received 330 odd million in, I think, March 2019. And of course, we know nothing was received after that. So on its own, not really a killer for them. They should have been able to continue, but all things being said, that was quite definitely, if they'd had that in their pocket, they wouldn't have stopped flying. And then with the revenue unceremoniously sort of stopped, we immediately we started speaking to the majority shareholders, and to sort of discuss a rights issue, just like Andrew did. And we got pretty much a cold shoulder. There was no rights issue on the table. The second plan was, okay, let's look at the recapitalization, start with the banks and other financiers. And again, cold shoulder. Just remember, there's a shock element here. All these people, the airline suddenly stops flying, and what do you do now? And everybody's scared, everybody's worried about the future of the airline, and nobody wants to commit a dime. And so pretty much the last resort left to the board, having tried to do something 6 months earlier, and I guess the chairman and the CEO at the time must have hated signing that resolution, but they had to file for business rescue. I think they did on the 4th, and it was registered. They went into business rescue formally on the 5th. So that, if you called, Andrew spoke about a perfect storm, that was a perfect storm. 4 things completely unrelated, but coming together at the same time. There's very little anybody could have done about it.
And then Bernard, running it remotely. I mean, in the first couple of months, we were in hard lockdown. I know Richard and Sean, the 2 practitioners who you work very closely with, had to run this business rescue from Cape Town. And just what was your sense of that? And, was it good? Was it bad? Some say the mute button on a Teams meeting is very effective in a creditors meeting where people are getting upset. Just what was your sense of running this remotely in those few months?
I suppose the positive is that we missed the tomatoes and the oranges being thrown at us, but probably running it from a remote location wasn't unknown to Sean and Richard. they'd done it, but it was never forced on them. But I mean, in my previous life, we used to run board meetings remotely, because just to fly 3 or 4 executives all around the country just didn't make sense. So but it was never forced upon us. It was always elective. But, you know, we got used to it very quickly, as we all have, I think. Some of us probably enjoy it now more than before, but the meetings, even with the initial meetings with the creditors committees and the employee committees, and even the banks formed, the lenders, lessors lenders formed a sort of a collective on their own. We were able to thrash it out. And so the hardest job of all of this wasn't so much whether it was remote or not, it was just getting this collective of committees to try and in some form sing from the same hymn sheet. You know, everybody at the time is shocked and wanting to protect themselves, protect their own interests, understandably. But eventually they've got to realize that the people sitting in front of them, including the board, are not the people who are to blame here. So, but nevertheless, it was quite, some of it was quite zesty. And some of the interaction was quite hot, but nevertheless, they got through it. Everybody, right up until the publication of the business rescue plan in September, somehow there was an understanding that the job had to get done. Some people were on board, some people jumped ship, and so it went on. But you know, the most important part, I think, was the relationships that were created, and the people who sought to sever the umbilical cord. They're the ones probably who aren't going to be service providers to the airline, having been rejuvenated now. Whereas a lot of the guys who had stayed in, who had kept their heads, stayed cool, they are now still service providers. And, you know, some of them, for example, if the debt was 100, say, in many cases, that was a month's revenue. And for, you know, an airline has a lot of noughts at the end of everything that it does, from the widgets on the wings to anything. But a lot of them, just since the 1st of June, since 1st of December last year when we restarted, they've made that up in revenue many, many times. It'll take time for them to regain the loss, but you know what I mean, that it's all relative. So I think it was difficult, but it was done, and it wasn't, you know, I don't think we worse off. We're used to it now, and I don't think there's any going back.
And just briefly, Bernard, the CRC, the Commie Rescue Consortium, you call them the CRC, just, you know, tell us a little bit about them. What is it? What are their plans? They obviously got confidence in the airline industry going forward. Just your interactions with them. What is your take on that?
Well, the CRC, as you say, Commie Rescue Consortium, is made up of a number of individuals. They're not sort of a random bunch of individuals. They're led by Martin Maritz, who, together with Piet van Hoof, and I don't know if you know, but these were the founders of Commie in 1967. So these guys have been around. So there's a passion there. There's a call it a knowledge of the industry, and so they came, and Rodney Sachs and Hilton Schlossberg, both very, very successful businessmen in their own right. I think Rodney Sachs, in fact, was a director of the company for a while until the late 2019. Stephen Herring, very well-known businessman, very experienced guys. And then, of course, Glenn Osmond was the former CEO of the company, and Kirsten King, and then Luthier Capital. So this consortium is led by a bunch of industrialists, people who largely, most of them are involved in the airline industry. And they've put it together. Their commitment is, I don't think, in question. I think they're committed every time. And, you know, it's an interesting thing. This is, you know, this last one in June was pretty much the third lockdown that Commie had to face in the space of just short of a year. Just over a year. And they've been there at every point. They've provided funding at the right times, and the airline is pretty much, as far as we can see, is on its way.
And just to end off, Bernard, I mean, really, you know, would you say, I would think that the Commie Business Rescue is a success. It's a perfect example, let's say a case study of a company that obviously goes into business rescue for good reason, and along comes a consortium, buys it out, has faith in the airline. It ticks the boxes of what I think business rescue tries to achieve. And hopefully, you know, we're hoping that we have a busy December, January season. Commie will get busier and busier, and hopefully into next year will continue to fly. Just your sense of the success factor of this particular rescue.
Well, Eric, it's difficult to say, because, you know, we are currently the custodians of the business. but the business has to fly on its own now, excuse the pun. So we believe that it's very close to ready. There are some issues that have to get taken care of. None of them relate to operational capability or profitability or cash flow. They call them side issues that have to be done. And but the airline is running itself at the moment. Since the active restart on the 1st of September, the load factors are very good. They're well above the break-even mark. The flights for December, are looking very, very, there's a lot of demand up. There's a lot of pent-up demand, and the load factors currently are good. The future flights are, I mean, a lot of the flights are full already for December. And what they call the coupon yield, the pricing of the tickets, they're not leading any downward spiral. They're actually out there price leading. And, you know, I don't want to be arrogant and say that's what they should do, but certainly they're not buying tickets. They're not buying bums in seats by discounting tickets particularly. In fact, the yields at the moment are higher than what they were in that 2019 period we spoke about. Now that was the benchmark, because it was a wonderful year, 6.5 million passengers carried, and it was a very, very good year, 2019. I think they made a massive amount of money. And so that the yields are back there. Just they don't have enough, at the moment, there are not enough aircraft in service because of the backlog of heavy maintenance.
Yeah, well, that sounds good to me. I mean, we could go on and on, Bernard. We could talk about the recognition in the United States of the business rescue process, but we don't have time. But just to end off, lessons learned, as Danny asked Andrew, you know, if you had to do it all again, would you have done it differently? You know, what does the learning curve look like for you?
Look, the learning curve is there's no one single item. Okay, as you know. As you know, Eric, I'm not a business rescue practitioner. I'm just a commercial guy. But this PCF thing is the thing that you need to organize as early on as possible, because it puts undue pressure on you at the wrong time. And I'm all for making decisions when you're in control of the decision-making process. When you're under pressure from all over, it's very difficult to convince people to contribute to that PCF. So rather earlier than later. The second thing which comes to mind is, you know, sometimes, I mean, business plans are business plans, and sometimes the best business plan isn't the best business plan because it's not completely bankable. So sometimes you've got to make sure that the entire process is rescuable. So, you know, I don't think you can go for a single point of reference. You've got to look at the whole plan from the beginning, through the people, through the plan itself, the detail of the plan, the funding, and whether everybody's going to be on board. And then you have to factor in stress factors. What if something doesn't happen? What if that doesn't happen? And I think perhaps we should have been more robust than that. We, of course, wanted to think that there's only going to be 1 or 2 lockdowns, and everything's going to be fun and games afterwards. Nobody would have anticipated the third. And I guess it's not a case of if there's a 4th wave, it's going to be there. It's just what the impact is going to be. So, and I think just as a last thing, Eric, just indulge me, as a commercial person rather than a BRP, the one thing which comes to mind is that the advice to all executives, in fact, and shareholders, don't wait too long. Recognize it early. The last people usually to recognize it are, in fact, the executives. But recognize it early enough that something can be done. Do it under control. I think if the new board had come in a bit earlier, maybe they would have had time. Maybe they could have done something. But when you argue yourself out of time, as this happens, things go pear-shaped very, very quickly. So don't leave it too late. That would be my advice to everybody. And of course, the very last thing is the rate. You know, the legislated rate was legislated 2011, still the same rate. To try and get people to do a business rescue for a large organization for a charge-out rate, which is less than a second-year article clerk, is, I think, asking somebody to jump over high buildings for the wrong reasons. So something needs to be done. We eventually argued a rate which was only the legislated rate plus an adjustment for inflation for 10 years. And so it wasn't asking too much, but it needs to be addressed. Otherwise, you're not going to get the right job done.
Yeah, no, agreed. And I think Alison's smiling there. I saw her smiling. It certainly is an issue that concerns all of us. And it's something which Saripa have canvassed government on to try and get those rates aligned. market-related rates. Bernard, thanks for that. It was a great synopsis of almost 2 years now of a rescue. Danny, over to you to chat to Mark from the Capital Group, some very interesting opportunities that Mark's come across.
Well, yes, Mark is going to talk to us in direct contraposition to the information and experiences that Andrew spoke to us about. So Mark's been involved in looking at, analyzing and identifying opportunities in distressed hotels and in the apartment sector. And he recently participated in the conclusion of a transaction involving the buyout of Fairmont Zimbabwe out of business rescue. And as I understand it, he's been famously quoted as saying, I think not the first person to say it, that property development is not for sissies. And I would agree with those sentiments. So, Mark, before we look at the Zimbabwe transaction, because I'm really fascinated by your experiences in that transaction, what are your views on the effect of the pandemic on the hospitality industry holistically? Because I've understood you to say that the distress was in existence a great deal before the onset of 2020. In fact, there has been distress or certainly pressure on the hospitality industry immediately subsequent to the 2010 World Cup.
Yeah, thanks for having me. So you've got to understand that there were a lot of hotels built for the 2010 World Cup in the leisure and the business side of hospitality. And then what happened was the ones that were built with high gearing went into an oversupplied market and got taken out, and the business rescues and liquidations happened, call it 2011, 2012, of which we were an acquirer of a few, and that was our first opportunity to grow. Then what happened was from 2013 to 2019, it's not as if everything was rosy in the hospitality sector. You've had big stresses in a kind of zero or near zero GDP environment where there's been inflation on input costs for hotels. You've got electricity going up, you've had rates and taxes going through the roof. And yet when it comes to asking corporate clients and even leisure clients for increases in rates year on year, it's been a struggle. So in the build-up from, call it 2013 to 2019, the whole industry has not performed incredibly well. It's been going backwards. And I think that left the industry in a position where there were a few, like Fairmont and Bali, that they were quick to almost use COVID as an opportunity, I say, to go into business rescue and say, you know, we were heading that way anyway, and to be able to throw in the towel. But then, you know, it just depended on whether, you know, some were highly leveraged, like they were, a lot of gearing, or it depended on whether you were some of the big established brands, and maybe you had built hotels in the 90s and the 80s even, and a lot of them were totally deleveraged, because remember, if the hotels, the last wave of hotels were built in 2010, the ones that could perform came 2019, had vastly reduced their debt, if not settled their 10-year debts. So you had a mix of the sector. You had sectors that were totally, hotel groups that were totally deleveraged, and some that were totally leveraged and used COVID to throw in the towel. Danny, you're on mute.
Not for the first and not for the last time, I'm sure.
By now, it's inexcusable by now.
I apologize, Mark. Mark, I'm a banking and finance lawyer by inclination and a restructuring lawyer by necessity. And I'd be interested to hear what your experiences have been and your interactions have been with banks and other financial institutions which finance the hotel sector. You've got lack of occupancy, you've got inability to travel into SA, and you've got ongoing financial distress, that must have caused concern on the part of the banks and their credit committees. What have your experiences been? How have you found your interactions with banks funding your existing enterprises? I'm not talking about acquisition finance. We'll get to that. But insofar as there has been leverage, how have you found your interactions with banks and other financial institutions that fund your businesses?
So I'll talk on behalf of the Capital Hotels and Apartments first, and I'll tell you that we are a private company with private equity funding from Buffett Investments, and we've been growing faster than the sector. So as a result of our growth, we've had to take on a lot of gearing. And so we're probably one of the more highly geared in the industry, as opposed to what I described as a lot to amortize and settle their debts. So when we went to the bank, saying, we're definitely going to need help, please, here. Can we go interest and capital rolled over? And we had huge support. We had huge support because I think the bank looked at us and said, well, listen, there's still good sureties, particularly on the Buffett side, our side, but what are they going to do with the assets? It's not as if they're going to do better than what we could do. And already by then, they started seeing that we were pivoting, we were changing our business into quarantine hotels, and we were actually generating quite significant income. So we had incredible support from the banks. And just looking at the industry and just, some chats I had between the bankers and the rest of the industry, they also had that support. Because what you've got is a black swan event.
Black swan.
It's not as if the banks could say that they're blaming anyone here. So they had to be supportive. I think politically, it would have been terrible if they weren't supportive. So they supported basically everyone. And the problem I've now seen is that, the support, obviously, if you're rolling up interest and capital, over months, it's been 18 months now, obviously gets to a point where the banks now do head into danger. With us, we actually went and serviced capital all along the way because we could. So we actually backtracked on that and we actually serviced capital. But interest they've carried for us over the period.
Interesting. Mark, what I was really looking forward to talking to you about was your Fairmont Zimbabwe acquisition. I think approximately 240 million value, 24,000 square meters of property. Tell us, what was the thinking behind the transaction and how did you implement it?
Well, we're quite close to the broker network. So we had heard rumors that it was heading into business rescue, and already we were kind of planting seeds to see who, what, when. But then it came out formally from JLL, just in the form of a full pack. And we followed the process. And by the way, we had managed to get our business through quarantine hotels into a steady state, a place. This is kind of between March, we went into first wave. And by May, we had steadied our ship. And this was about September that pack came out. And so we kicked the tires like everyone else. And we were quite positive that there was going to be a second wave. And so we never went in with any kind of aggressive deal, unlike quite a few others who wanted to put big numbers on the table subject to funding, because we knew you wouldn't be able to raise the funding. See, the problem with these opportunities is you can have incredible opportunities in the hotel and leisure industry, but if you can't raise the funding, then you can't do the deal. And it was just at the time where banks, if you think of some of the big four banks, they were quite full up with hospitality issues, trying to get out of their hospitality exposure. And here we would be going to them saying, can you lend us money? So what we did is we asked Nedbank and Investec, were the main security holders there, just so happened to be our main bankers on our side, and they knew our track record. We asked them to roll over the loan, and we would put in some equity, and that was our bid, and that was a way of actually getting them 100 cents in the rand or close to that. But through that process, what happened was different banks, different securities, they couldn't agree with one another. And so it landed up getting to a point where it needed to be a cash-only deal. And by then, quite frankly, we were the only game in town, because the second wave had now hit, and it was January or February, and whatever hope there was that there would be another buyer wasn't there, and we were the last man standing. And so we raised the funds actually from Fed Group, came through for us. And it was actually quite a straightforward acquisition from that point onwards. It was a standard acquiring out of business rescue and putting the cash in, and off we went.
And Mark, I mean, I've got a million questions to ask you, because yours is a very positive interaction, if I can put it that way, acquisition out of opportunity as opposed to disposal out of distress. What is your view in relation to the opportunities that are available and will manifest themselves during 2022? Are you, and for example, your group, still on the acquisition trail? Are you looking for opportunities?
Yeah, very much so. We always use the bad times as the opportunity to grow. And that's how, in that hang-up of the 2010 World Cup, when there was an oversupply of hotels, that's why we went shopping in 2012. You know, it took 2 years for, you know, the rot to settle through until it got to a point where the distress came in. And I think the same thing's going to happen here. The hope is that, like I said, there's a lot that were never leveraged in the first place, a lot of hotels. So I don't think the same distress exists in those ones. And then the banks have been incredibly supportive up till now. Business interruption insurance is going to play out now in the industry. I don't know if you've seen the case with Mar Africa that the industry won 2 weeks ago to get full cover on business interruption insurance. So that could put liquidity back into a lot of clients, or the clients that had a lot of cover. But it's going to be quite interesting whether the distress comes out now or not. I think that the ones who have managed to survive up till now could very well trade out. They could very well trade out, and we might not see as much drama as we saw, because it was fundamentally oversupplied, the industry, in 2012, and it's not as fundamentally oversupplied today.
Thank you, Mark. Eric, over to you.
Thanks, Mark. That was really interesting, and obviously business rescue opportunities will always be there. Good times probably ended bad, but thanks for that. That was excellent. Andrew Stock. Andrew, Flight Centre Travel Group must have had a pretty rough time if you go back to, let's say, January 2020 onwards into 2020, which everyone wants to forget that year, just cross it out. But how did you guys cope as a travel group in a situation where no international visitors arriving, very little local travel, hard lockdowns, and how are you seeing it in respect of coming out of that position and going forward into the busy Christmas season and beyond?
Yeah, hi Eric, hi everyone. Yeah, it's been a fascinating chat, and I think you can see I've got a smile on my face, because we've had 3 months of high demand, and we actually can't keep up with the demand right now. So things have bounced back pretty quickly from a leisure perspective. But if I go back in time, and a lot of the colleagues on the call, that's exactly where our heads were at, was we said there was no risk register anywhere in our business that said a global pandemic's going to hit and wipe out your income within a couple of days. And that's literally what happened. And I think what saved us is a couple of things. We acted with speed, but we are a listed company with global reach, and we could get funding. And I think what I realized very quickly is cash is king in a time of a major crisis. So we had deep pockets both locally and abroad, although abroad we had to go and raise $1.4 billion quite quickly. And what's really interesting is the markets are very open to investing back into hospitality, which tells you that they see a future for us over the next 5 years. If I look at where our share price actually was about 2 years ago, we were seeing about $75 on the ASX. That dropped down to a record $9 during COVID, and it's now back up to just over $20. So you can see there's certainly a conviction in market that hospitality and leisure will certainly come back in time. But that was 18 months ago, and I'll be honest with you, don't waste a crisis to make some tough decisions. And that's exactly what we did. You know, we closed down underperforming brands that we probably didn't have the stomach to do during better times. Unfortunately, we had to let people go, but we're in a position now where we're employing people again. And we always promised that we'd bring back our people that we let go. So we're in a good position now. I must say the last 3 months, you know, the minute these countries have opened up and the minute the airlines have put inventory back on routes, we've been able to, put customers back into hotels, onto seats and back into countries. I think for us as a company locally, we had to pivot very quickly. 70 to 80% of our business was long haul international travel. So, you know, we had to say, well, that's gone. Now we've got to focus on domestic. The reality is domestic didn't pay the bills. It just kept our people productive, and it gave them a purpose. And I think this mental wellness and well-being of your workforce is something that probably we'll only unpack now. But that's something that I certainly try to do, just make sure our people were productive for as long as possible in the day as possible. There's 8 hours in the day. Some hours in the day there was no business, literally no business for a number of months. So where we are right now is demand is well exceeding supply. We can't keep up, which is a good thing. Is this a bubble before the fourth wave? Is there going to be a fourth wave? Absolutely, there's going to be a fourth wave. I certainly hope we follow Boris and the UK and the Europe stance in starting to live with this virus and saying there's probably two avenues, a vaccinated route and an unvaccinated route. And if you're vaccinated, you're going to have a much easier journey when traveling, specifically leisure or hospitality. And if you're unvaccinated, there's going to be a little bit more of a difficult road for you to get from point A to point B. And I think Boris has got the right attitude, is that we shouldn't be going backwards. We shouldn't be looking forward. And if the way I'm seeing, the US opening up, UK, Europe, even Australia, and New Zealand, we won't talk about New Zealand yet, but Australia are opening up their 2 states there. I don't see us going back. I see us certainly going through a fourth wave, living through it, having a high, hopefully getting the vaccination rate to where it needs to be, but having, people getting COVID, that's one thing, but then, obviously people getting through it is another thing. So I'm usually optimistic that we probably are through some of the worst that we've seen, because we really have been in the worst. So far, there's many green shoots, as my colleagues have mentioned on the call today. And I'm looking forward to what the next couple of months brings us as an industry. We need some good luck, to be honest.
Andrew, just one of the interesting things with an influx of, say, they're talking about 300,000 visitors from the UK hitting our shores in the next month, in the next 3 months. Do you think that could potentially contribute to a fourth wave? Do you think, obviously people coming in here are going to be vaccinated? Just what is the travel industry, what is their view on whether or not it's going to be worse or get better?
Look, I'm not a doctor, but I mean, I think one thing we can say is that we desperately need the foreign income. We desperately need the tourists. We've been bleeding for the last 2 years, and we've been very fortunate in South Africa. We've got a strong domestic travel market. So our South African market has certainly helped our previous inbound market survive this period. But we certainly don't have that probably as a foresight to the next 6 to 12 months. What we see from South Africans from an outbound perspective is they want to leave, they want to get out of South Africa pretty quickly, as in holidays, vacations, visiting friends and family. The minute the UK opened, we sold something like 10,000 tickets in the space of 3 days. And that's just getting South Africans back into the UK and back into Europe. So we must remember, South Africans, we've got lots of family and friends around the world over the last, sort of 20 to 30 years. And there's a lot of people haven't seen their family and friends for the last 2 years. So there's this huge pent-up demand that we're certainly going to see, as much as we've got South Africans living abroad, needing to get back in here. Again, I think, if everyone's vaccinated and they're traveling, will there be an infection rate? Absolutely, which we're seeing in the UK, but we're not going to have any hospitalizations. And then hopefully we learn to live with the virus. It's something that's going to be around for a while. I don't think it's going to go anywhere anytime soon. But as colleagues mentioned on the call, social distancing, wearing of masks, sanitization, and being vaccinated all aids us getting back to some level of travel normality.
Thanks, Andrew. That was fascinating. And I'm sure your big challenge next year will be to get businessmen back on aeroplanes, not just leisure. But I'll leave to you and your colleagues. Stefan and Alison, I'm going to kick off the Ernst & Young view on what we've been discussing to wrap it up. Just generally, you've heard the views from our colleagues on the call and from spokespeople in the leisure and travel market, hospitality. Let me start with Alison. Just your views on the impact of COVID generally on South African companies. And if you can maybe just share with us, and I'll ask Stefan to also give his 5 cents worth on what happened with Ster-Kinekor.
Sure. I mean, I think in some ways, COVID has obviously had a massive impact, and this industry discussion is absolutely supports that. But in other instances, I think, Eric, and it was alluded to a bit earlier, there are a lot of companies that were probably already on a slippery slope and a very weak footing. And so COVID has really accelerated and exacerbated a whole lot of these issues. And I mean, when you ask, how does COVID impact? It's, I need 2 hours to probably answer that. But I suppose there are 2 categories, and one is the financial side, and really a lot of that has been around liquidity. I think increasing balance sheet problems. We've got a lot of insolvent issues out there. And then I think secondly, operationally. So if you look at things like supply chains, we have seen an enormous amount of problems there, whether it's COVID related, suppliers falling over as well. And so what I call the stakeholder landscape has just become a whole lot more complicated. And if I go back to the sort of old days of restructuring, you were far more in control, I think, of what you were doing. Now you've got to look a little bit further and say, what is it that my suppliers are doing? What is it that my customers are doing? How stable are they as well? And from a Ster-Kinekor point of view, I think it's obviously something that is ongoing, but perhaps a couple of principal takeaways, and the first is the point around the stakeholders. So, think about things like landlords. That's a massive and important stakeholder group. What are they doing? They all have slightly different, I suppose, takes on recovery periods, what the investment committees will or won't allow. And then I think really the second point, Eric, was around this, what came out as a very a good reminder that a lot of companies have very much failed or been in the doldrums, I suppose, because of COVID. But as many as that have also been probably headed that way anyhow. And I think from a restructuring point of view, as an industry, we're going to have to unravel some of that quite carefully. And it has a huge amount of implications as to whether or not the root cause was actually COVID. So in Ster-Kinekor's case, and obviously the leisure industry, we don't have bums on seats anymore, so we haven't got the cash income coming in. And but that should correct itself, and there is some level of recovery trajectory. Whereas there are other businesses that I think, and there were some words used earlier about sort of final nail in the coffin, and I think certainly we've seen that, and those businesses probably need to be liquidated and start up again in a different shape or form. So a myriad of I think permutations and issues and winners and losers, I suppose.
Stefan, your views, and I'm sure James Bond must have helped a little bit with Ster-Kinekor, am I wrong?
Absolutely, Eric. I think, just quickly on Ster-Kinekor, it's something that is a bit of an anomaly. I think I would call it a COVID unicorn. It's one of the few businesses that can really say they were doing super well into the face of COVID, and COVID was just this cataclysmic event that really caused the shutdown and forced them to batten down the hatches and figure out how to get through. That said, by the time we reached them, given the fact that it had been up until then a very well-run business, it was much more resilient to those issues, and it was quicker to come back when demand came back. So they were super alert during the early stage of level 5 that Bernard referred to. They already got their ducks in a row. They figured out how to get a lot of variability into the business as quickly as they could. And they were primed for any demand as soon as it came back, and they harvested it. I mean, by the time Alison and I arrived, they were able to tell you on a Thursday whether a centre should be open or shouldn't be open on the basis of cash generation or not. And so they were making really quick decisions, which was, I must say, hence the unicorn statement. I mean, it's probably the first time I've seen it in 15, 20 years. So, I mean, I guess that's a bit of a skewed view. And it has been a bit of a textbook rescue in that regard. I think its challenges are no different than restaurants. I think there was lots of talk about now that we can get our favorite food, at home, does it mean that we won't go to a restaurant? I think, the reverse is happening. The restaurants are full and you can't get in. And certainly from Ster-Kinneckel's perspective, if the content is there, our customers are back. So I think, the better the content, the better the showing. Globally, the recovery has been very quick to bounce back in the cinema industry. And therefore, we've had a very V-shaped kind of crisis within Ster-Kinneckel, whereas a lot of others have been much more drawn out, I think.
Danny, you have some questions?
Yeah, Stefan, I mean, you and I are involved in a particular business rescue at the moment. And what has struck me forcibly, and I've been on the opposite end to you, what has struck me forcibly is that a lot of institutions, as you've alluded to, have relied on and I use the words advised, the excuse of COVID to ask for assistance in various forms from the financial institutions. And that, whether it was in the form of moratoria, in the servicing of interest, or the provision of short-term liquidity, is my instinct is that patience is running out, that the chaff is being separated from the wheat. The unicorns have been identified, to use your terminology. What is your experience in relation to the provision of liquidity to distressed entities by financial institutions, the so-called first-tier providers of finance? Do you think that there's still appetite for the provision of finance, a recognition of an absolute need to provide it, or do you think that the appetite is waning? Is it becoming more difficult to raise short-term liquidity for distressed entities?
Yeah, again, another one of those enormous questions, Danny, but I'll maybe box it into sort of two areas. I mean, I think from a existing funder perspective, I think it is all about, firstly, the credibility of management, the ability to rely on the quality and the speed of the information coming out to enable the banking institution to be able to get this past a credit committee. And the first test is when we're working alongside them is, would we bring new money into this situation? Because the existing lender has got a difficult position in the sense that they've got value at risk. So it may well be that they have to put more liquidity out. But any banker will tell you that that isn't a have to, because sometimes your first loss is your best loss. And so I think there's a level of complacency assuming that the existing bank will and must bail out a business. And I think businesses need to be much more savvy about getting to a point where they are reinvestable even by the existing financiers. And then secondly, really in terms of attracting new capital, again, that is unattractive in the sense that if you're coming in and second ranking or back ranking, how's that going to work, and what's going to be the priority on an exit? And that's where rescue and post-commencement finance could have been much stronger had we had a much better ruling around the ranking of post-commencement finance. Not that it should exceed that of senior secured, but also that it would actually have its requisite ranking and allow people to say, if the existing lender doesn't want to go, but we think this business can cope with the gearing and can come out of it in due course, that would have been easier to attract capital. So I think we're still lacking with an insolvency regime that allows really good opportunities around distressed investing. Certainly from our perspective, we spend more time with people pre-rescue looking at those opportunities and looking at a refi rather than a rescue kind of bailout.
Alison, if I may direct a question to you, and it's a little bit of, it's a trick question. It's, doctor, am I going to live or am I going to die? Looking back over the last 18 months, what in your view are the factors that will determine who survives in a COVID environment as a business enterprise and who doesn't?
It's a trick question and a hard question, Danny. I mean, I think, you know, I don't think it's as easy necessarily to say there are winners and losers because of COVID. And we go back to these principles of, we go back to first principles in my mind. So COVID at some level is the root cause of distress, if we want to put a sort of advisor hat on at the moment. And so I think if you go back to these first principles, and the Sir Kinnico and the you know, the hotel industry is a good example, I think, of some of these. We've heard from the panel today how a management team have managed to steer themselves out of it, what they've been looking at. And what struck me, and I think when I answer your question around factors, is this point of pivoting. I think I heard the word, and agility. So you're talking about management looking at things like, how do they build trust in society again? And it's a very important and soft point, but I think one that is ostensibly linked to how these businesses come out of it, you know, if they're a winner or loser. So am I confident to go back into the cinema? Am I confident to go back and stay at a hotel? You know, coupled with that, again, we heard from Andrew, for example, management's dealing with the balance sheet at the same time. And so I think the winner category, if I can categorize it like that, are businesses that have looked at both operational and financial, and put themselves in a sort of more future-proofed state. I think the other aspect is how businesses have actually dealt with the COVID period from a financial point of view. So I suspect we're going to see businesses that have managed to take on quite a lot of debt, and I think come onto the sort of COVID loan government support, but I'm sure we're going to see examples of businesses that have taken on debt ostensibly to fund trading losses. Where do you get to at the end of it? So a business that might be back on track in terms of trading, some of the customers are back, their revenue levels are starting to look normalized, whatever that word means, but they are saddled with a huge amount of debt. And if you look at some of the loans that are out there, they are ostensibly short-term, they've hardened, so they're sort of textbook indicators of distress to me, or potential stress down the line. And so that's all dictate, I think, whether you're a winner or a loser. And I really think it's, you know, there's some that are in the of should never have survived and didn't survive, and others like our famous unicorn example that's probably will come out, but you know, has a sort of period of time to go in terms of just, you know, sailing with the sails it's got and coming out at the other side, whether it's through lockdowns or more waves, etc. So I think it's a myriad, Danny, of factors that will dictate, you know, ultimately who you are. And I think the lasting point there is, as well as, I don't think we've seen who the winners and losers all are at this stage, because we've got a lot of short-term fixes that we are dealing with. And again, I suspect there's a huge amount of refinance risk out there, a lot of short-term liquidity risk that still hasn't been dealt with. And when you start unwinding that, I think you're going to see a few more victims as well. And again, I think to Mark's point earlier, opportunistic acquisitions and bolt-ons.
Okay, I think we're going to have to start wrapping up, Danny. It's been a fascinating discussion, and I must say, just quickly before we go to everyone's last views on the leisure industry going forward. Just Stefan, business rescue is a restructuring tool. You've heard from Mark, you heard from Bernard as to how acquisitions can actually really create value. Just briefly, your sense of that and the opportunities created by the rescue system.
Yeah, I think, Eric, the legislation is there. I think it's one of the tools in the box. I think most of us will tell you that we reach for all the others in a consensual restructuring well in advance of choosing rescue. And I think we've yet to see anything that resembles a pre-pack. I think we were destined to maybe see one this year, but it's slipped by. But I think, you know, rescue has its place, but it is a complicated place to be doing it. It has a whole bunch of extra pressure points that I think Bernard had alluded to as you know, the challenges that were sort of extended by virtue of rescue, coupled with COVID, coupled with remote working and those things. I think the challenge for rescue is really, it's there when you've got a straightforward situation and a clear exit. In a very large multi-entity group, it becomes increasingly difficult to pull it together because you almost need to have you know, plans in each of those that actually all bind themselves together, and therefore the risk of failure becomes higher because you just need one to fail and the basket topples.
Okay, thanks for that, Stephen. Just to end up, guys, one sentence. That's all I want from each of you to wrap up. I'm going to start with Andrew Johnson. You know, I think it was Andrew Stark that said, never let a good crisis go to waste. So just a response to that, Andrew, just to wrap up your final thoughts. Andrew Johnson first, and then Andrew Stark.
I think, Eric, I think the issues have been touched on. I mean, I think agility, you know, creative thinking, entrepreneurship are really valuable lessons that any modern day company needs to embrace. You know, I think succession planning and diversity on boards are going to be big areas that are going to become focus areas if they're not already. Yeah, and I think those were really the key takeaways, you know, which were very valuable lessons for us, and which allowed us to manage to avert any, you know, business rescues or whatever, and to obviously position ourselves well for the future.
Andrew Stark.
Yeah, Eric, I think for me, I think COVID taught us there's no such thing as rules. So throw the rule book out the window and start all over again as well. And I think the opportunities for the sector is vaccination rates. How quickly do we get people vaccinated? It will open up our world a lot quicker. And hashtag travel boom, may it continue.
Mark, your views?
Yeah, I think people want to travel, and we're in an industry that will fundamentally be different. There's going to be more of this Zoom meeting than there's going to be travel, but don't discount the fake business trip is what I say. There's so many people who would love to, they could do the virtual meeting.
Business or golf trip, Mark?
Yeah, exactly. They could do the virtual meeting, but they'll very happily jump on a plane to Cape Town for a holiday.
Absolutely. Alison, your final thoughts?
I think there's a lot of permanent change coming. So, you know, my takeaway and thoughts are really around what is this wonderful new normal that we're talking about. And I suspect it's time to unlearn what some of the things we've learned and you know, reset. And certainly from a restructuring point of view, I think there's a lot of opportunity and I suppose space to be creative and really get the results we want, you know, the job preservation, the proper turnaround. This is not a time to delve into a textbook. It's a time to bring stakeholders together and really find clever, logical solutions. So I think an interesting few years ahead of us.
Bernard, are you still there?
Yeah, I'm still here. And Eric, thank you. Yeah, I mean, you know me, Eric, there's nothing short in my sentences, but really, if you do happen to, you know, don't leave it too late, but if you do, I think make sure you surround yourself by good people who can help you pull it together. And that would be my sort of parting line. And, you know, there's nothing is forever. And Alison mentioned it, this is a Control-Alt-Delete, it's a restart for the world, really. And the sooner we get used to that, the better.
Stefan?
I would say, Eric, have a plan, and invoke it now. Don't wait for when you think it's needed, and be strategic. I think people think strategy can only be used in the ordinary course. It's quite the reverse. The best time to be strategic and opportunistic is at the bottom of the curve.
Thanks for that. Firstly, I want to thank all of you before I ask Danny to close. Andrew Johnston, Andrew Stark, Alison, Bernard, Stefan, Mark, really appreciate the time that you've taken to join us today. And I can tell you that the participants who listened in have all stayed on, that they haven't left the room, and I'm sure they really gained from your knowledge and from your shared experiences. So I really would like to thank you all for participating. Danny, your last thoughts before we close?
My last thoughts are that I'm a perpetual optimist. I've got absolutely no doubt that given how durable mankind has been, I've got absolutely no doubt that the leisure industry will flourish in days to come.
Great. Well, from as you say, from your mouth to God's ears. And I want to again thank everyone for participating, for joining us today, and for the time taken by our panelists. Thank you very much. We'll leave it there. I wish you all a good afternoon. Thank you.
Thank you, everybody. Bye-bye.